value investors should first look at the business and then look at the price?
Value investors tend to look at the price first. Is price really the best indicator of value? I found that it's not.
What's your thoughts on index funds or like a smart portfolio made up of companies?
I think index funds are fine for people who really know their limits. On the other hand, smart portfolio is very good. Like, let's pick 15 stocks that are tech companies that have moats that are reasonably priced. Yeah, I like that idea. So that's the definition of a moat. That's what you want to look for. Have people taken a run at this business and they can't? Amazon, Alphabet, Intuit, that's the litmus test you want. And this market correction is sort of saying most of these companies don't have moats, but some do, and those are the ones you want to be buying.
Hello and welcome to a new episode of The Ball Club, Conversations with Leaders, where you can get valuable insights from successful investors and financial leaders from around the world. My name is Sam North, the trading school lead at eToro, and I'm happy to be your host today. Our topic today is value investing in the digital age, an age that divides the value investors into two camps, the so-called deep value, Ben Graham style, and the Warren Buffett, Charlie Munger, moat like a business style. Our guest today is a successful investor and a contributor to Barron's and Fortune. Adam Seessel, the author of Where the Money Is, a dedicated and fascinating book dealing with this debate between the two value camps. Adam, it's great to have you with us today. How are you?
Good, Sam. Thanks for having me, and thanks for the kind words.
Amazing. And you're tuning in today from New York City, I understand.
New York City in the heat of the summer.
I was going to say, is it pretty hot there right now?
It's been okay. We haven't had too many steamy days, but I was at the Yankee game last night, and it was a little hot.
Yeah, we're currently in London. We've had a few days 30 degrees Celsius, and I think Monday's gonna be 36, which for anyone in London is just way too hot. We're all melting and so on over here, but I understand it gets very hot in New York, so I'm not going to complain too much.
That's right. I've had a couple London summers. They're lovely compared to New York.
Yeah, a lot cooler. Look, we mentioned the book there, and in your book you outline the footsteps of value investing to value 1.0, 2.0, and now value 3.0. Can you explain these steps to our listeners that haven't read the book yet?
Sure. Well, it's pretty simple, Sam. 100 years ago, a brilliant man, self-taught guy named Ben Graham was on Wall Street as a young apprentice, and he saw all this crazy speculation going on. It was legal in his time, actually, for a Wall Street firm to take bets for the presidential election. So that's the kind of place that Wall Street was 100 years ago. It's just basically a glorified casino. And he said, this is insane, and he needed money. His father had died, and he was supporting his mother and brothers, and he needed a system to make money. So he devised a system which became really the backbone of financial analysis. So anytime you take a financial analysis class, you are taking essentially, Ben Graham's class. And what he did was use financial statements, which were in the process. It was good timing because financial statements were just in the process of becoming standardized and transparent. But his style, Sam, was asset-based. He focused on inventory and property and plant and equipment, precisely because everything was so speculative on Wall Street. He wanted tangible assets that he could physically hold and identify, and that could be liquidated quickly.
Yeah.
And so when stocks were selling below that liquidation value, that's to him was a good value. So after World War II, he taught at Columbia University Business School. 1950, 1951, a young gangly guy from Omaha walked into his class, whose name was Warren Buffett. Mm-hmm. And Buffett became the only student that Ben Graham ever gave an A+ to.
Wow.
Yeah, because he was brilliant. And his partner, Charlie Munger, says he was a prodigy. And he began by adopting, with whole cloth, his mentor's asset-based strategy. But as time went on in the 50s, he saw that America was a very different place in the world by extension. It was no longer a speculative boom and bust stock market. Securities and Exchange Commission was firmly entrenched, and financial statements were getting very transparent, even more transparent and reliable than when Graham came along. And he also saw, more importantly, that the economy was stable, that there weren't, the panics of 1907 and the depression of 1929. Of course, we still had recessions and market corrections and so forth, but America and the post-war world was stable and prosperous and growing steadily. And so he said, you know what, I'm not going to focus so much on the assets, because the real value of a company is how much they can earn. I'm going to focus on their income statement. So Disney, for example, which was one of his famous early investments, their value of their company does not reside in the liquidation value of the rides at Disneyland. It resides in that pixie dust that exists, the connection between the consumers of Snow White and Alice in Wonderland and all its movies, which drives people to the movies and the parks and the merchandise and so on and so forth. So he really focused on, as you noted in the intro, the quality of the business. And moats is his famous metaphor to describe a business that is immune more or less to competition. And it has very little to do often with assets. So that was value 1.0 was Graham, and value 2.0 was Buffett, more franchise, the quality of the business. And then what I'm recommending is value 3.0, which is basically an extension of Buffett's moat concept, but centered much more on the digital age, and pointing out that since the late 20th century, the world has changed. And many of the moats, what constitutes a superior business, have changed. And many, if not most, of the businesses with moats now are digital. They're in the ether. They're software-based companies. They transact in zeros and ones. And so it's time for value investors to evolve to encompass these companies.
Yeah, no, it's really fascinating. I think in that journey throughout the years, I mean, the main change, or one of the main changes in this digital age that you talked about, in the way that accounting works for R&D and marketing, can you sort of explain that sort of change, what we're seeing, and has that been present for quite some time?
Well, yes. I mean, it's sort of like Graham and Buffett, in the sense that accounting is important. And, accounting was the recent GAAP accounting that we have here in the US was promulgated in the 1930s, when US Steel and General Motors were ruling the roost. So it's still very much asset-based focused. And it basically rewards companies through the profit and loss statement that build tangible assets. It allows them to depreciate them over 20, 25 years. And it penalizes companies that invest in R&D by requiring them to expense 100% of all the expenditures in 1 year. So, as I say in the book, every dollar that Google invests in making its search engine faster, more relevant, is deemed by GAAP accounting to have a 365-day useful life, which is ridiculous, because the dollars that Google spends to improve its moat have many year life, but every dollar of that expenditure is expensed. Whereas for a factory, you get to put it on the balance sheet and capitalize it and depreciate it over 20 years. But there's also a qualitative dimension, Sam, that's really important. It's not just the accounting. I mean, as I say in the book, these software businesses are just inherently better mousetraps than any business we've seen, mainly because they have no cost of goods. In the book, I contrast, say Google with Coca-Cola. Coca-Cola was one of Buffett's great late 20th century consumer products investment. And he was like, wow, this is crazy. Their ingredients are sugar and water, and they put it in a red can and people love it. And they can't get enough of it. And when they try to change the recipe, people object. That's the kind of business I want. Well, that was a great business, but software companies are even better, because they don't even need to buy sugar or water. And they don't need to invest in bottling plants or trucks or vending machines. When they want to expand into a new geography, they just hit a button and boom, it's done. So these are much better businesses inherently. They're better cash machines, and that's important as well.
No, absolutely. I mean, I probably know the answer to this question. I reckon people listening will as well. But if Warren Buffett had started investing today, do you think he would have as good a time now? Do you think he'd be able to adapt straight away to this new world, this new digital world, and get the results that he had?
Yes, yes, I do. I mean, as I say in the book, and I think he was 75 years old when the digital age really kind of took off, maybe 80. So, we can forgive him if he's not quite hip to email and texting and TikTok and so forth. But the guy's a learning machine.
Yeah.
And look, he's done well with Apple, and he understands the digital economics that I've just outlined. But he's sort of anchored a little bit in that late 20th century value 2.0 mold, where he's looking at great businesses, but tech businesses he doesn't really understand. They always look expensive because of the accounting, also because they're just investing so much more money in the future than some of his favorite businesses. So they don't look like the late 20th century franchise businesses that have made him one of the richest guys in the world, and that's why I don't think he's more all over them.
Yeah.
But,
go on. Sorry.
No, I was just going to say. I mean, look, value investors really have a reckoning here in the early 21st century, because you have to look at companies like Google and Amazon and other lesser companies like Intuit and Adobe and companies that we don't always talk about, but that have equally powerful moats. These companies have looked expensive for years and years.
Yeah.
And Amazon didn't make money for a third of its publicly traded history. It showed losses. So, either, we're in for a dot-com bust that is going to make the first one look trivial, or the metrics we've been using as value investors need to be tweaked. And I suggest it's the latter, because Google and Amazon aren't going anywhere. And, not to mention a whole dozens of other smaller companies like Adobe, Intuit, and so forth.
Yeah, well, let's talk about that. I mean, some, in markets, we've seen a sort of a brutal correction, I guess, in some of these tech, sort of digital stocks, and even in some names you've sort of mentioned there, the larger caps, but also the smaller ones like Roku, Wix, that I think it's 70% from their highs. How would you deal with that? How would people deal with that? And did this change any of your thinking, since writing that book at all?
No, not at all. In fact, it's sort of reinforced the thinking, Sam, because I mean, look, I think the correction is very healthy, because it's separating the wheat from the chaff, the babies and the bathwater. And it's all about moats, competitive edge. Who's got the edge over the competition? I mean, look, 90% plus of all tech companies are going to suffer the same fate as all other tech companies. It's not like you should just run out and buy a bunch of tech companies because they say they're tech. It's about the quality of the business. Have people tried to compete against them and failed? That's when you have a moat. So, Google, Bing spent $15 billion. Microsoft spent $15 billion building out Bing. Couldn't do it. Couldn't get traction. Amazon tried to build a search engine. It's less well known, but Amazon tried to build one. Bezos hired the guy who built Yahoo's search engine. And he quit after a couple of years and left to go join Google.
Yeah, I mean, whenever I go onto like a new computer or a laptop, if they haven't got Google, I think, God, I've gone back in time like 20 years here.
Yeah,
so it just shows how good they are.
So that's the definition of a moat. That's what you want to look for. Have people taken a run at this business and they can't?
Yeah,
and I would suggest Amazon, Alphabet, Intuit. That's the litmus test you want. And this market correction is sort of saying, most of these companies don't have moats. But some do, and those are the ones you want to be buying.
Yeah, that's really good. I hope people remember that and listen to really take that from this webinar. I love the way in your book you described that today value investors should look backward, meaning first look at the business and then look at the price.
Yeah.
But for those that maybe don't quite understand what that means, how would you sort of explain that way of thinking?
Well, it's funny the way you phrase it, Sam, because value investors, as the name implies, tend to look at the price first.
Yeah.
And I had to really reconsider that because 5 or 10 years ago, I was looking at price, buying cheap stuff, and it just kept going down. And I had to say, well, is price really the best indicator of value? And I found that it's not. I mean, of course, it's better to buy something cheaper than it is more expensive, of course. But, if you buy a turd that's cheap, it's still going to be a turd.
Yeah, no matter how much you polish it. Yeah.
Whereas if you buy a great business, especially if you buy it for a reasonable price, and the thing about great businesses that have moats, they'll be able to grow their earnings immune from competition for many years. So if you start at a high multiple, the stock will grow into its earnings, so to speak, because the earnings will grow. So the multiple will come down as the E in the PE increases. Whereas if you buy a cheap PE stock and it's just a bad business, you know what? The E is going to decline and the multiple will actually expand. So the business quality is most important. And Buffett's known this forever. It took me a little while longer to figure that out.
Yeah, well, I think if it's good enough for Buffett, it's got to be good enough for the rest of us, I imagine.
Yeah, and it's amazing how few people really, when they say value investor, they think price. But Buffett is a value investor. Everyone would agree with that. But he has written quite clearly that, 30 years ago, he wrote in an annual report, a low PE and a low price to book ratio is not consistent with a value purchase. And a high PE and a high price to book ratio is not inconsistent with a value purchase. It all depends. And mainly what it depends upon is the quality of the business.
Yeah, that's absolutely.
He was worried when he bought See's Candies in the early 70s. He was worried that he was overpaying by, I think, $5 million. And you know how much See's has generated in pre-tax profit since he bought it?
How much?
$2 billion. So he was worried about 5 million and he got 2 billion. And that's directionally where your head wants to be at. He chides himself for missing Walmart because he kept waiting for it to go down, an eighth of a point. He's chided himself for missing Alphabet, for missing Google. And so you can really, get yourself hung up on price. You still want to be price disciplined. You still want to be disciplined. But it is business quality first, if you ask me.
No, that completely makes sense to me. The margin of safety is one of the most important requirements in that sort of overall value camp from Graham to Buffett, as we've sort of mentioned. How do you implement that in Value 3.0?
Well, you can't really implement it quantitatively in the sense that there's a security within the Ben Graham sort of liquidation style, like, oh, I'm buying $100 worth of assets, but I'm only paying $50 of assets. So, if it's liquidated, I'll get $100, but I'll only be paying $50. So there's a sense of security there, but I would argue that it's often false for a couple reasons. Number one, you're not in charge of the company, so you can't liquidate it. The management has to liquidate it, and often they don't because that would put them out of jobs. So there's a built-in institutional bias against, realizing asset value, right? Secondly, those kind of businesses tend to be bad businesses. If they were good businesses, they wouldn't be selling for 50%, 50% of their liquidation value. So they tend to be dogs. And, especially in this digital age where the change, the change of technological change is so rapid, if you're on the wrong side of the digital divide, it's very hard to leap it. We're seeing even companies like Netflix they used to be a leader and now they're struggling. So you have to really stay. So if you're an old school business selling at 50% liquidation value, I would suggest it's going to be very hard for you to come back. So the margin of safety in my book, Sam, is qualitative. It's not quantitative. There's a false sense of security in penciling out the numbers and saying, oh, I've got a margin of safety. Look, well, yeah, but you bought a crappy business, man. The margin of safety is in the business quality. The margin of safety is I'm buying Alphabet at 19 times earnings, which is the price it is trading at now.
Yeah.
And in 5 years, I'm going to make this up, earnings will roughly double.
Yeah.
So in 5 years, Alphabet is going to be trading for 9 times earnings, but it won't trade for 9 times earnings because it's one of the best businesses in the world. So if the earnings double, the stock doubles in 5 years, and I have a 15% return.
Yeah.
That to me is the margin of safety. I have a business with a moat that's going to grow, and those are, the stock is going to follow the earnings growth, and the earnings growth is going to follow the business quality or the moat.
Wise words. We've mentioned, or you've mentioned a few times, Intuit. So, in explaining their growth phase adjustment, you compared it to Campbell Soup, the famous food brand. I guess 2 questions. Isn't it like a way different sort of business model? And additionally, Intuit as a technology company, is that maybe not more vulnerable to, say, competition than brands like Campbell, or not really?
Yeah, very good questions. My point in trying to compare Intuit and Campbell's was trying to get at that better mousetrap dynamic that I mentioned to you earlier.
Yeah.
Campbell's gross margins, if I recall, is 35% because they have to buy, chicken and noodles and tomatoes, and they have to buy stuff, and then they have to make the soup.
Yeah.
They also make Pepperidge Farm cookies, so they have to buy sugar and chocolate and flour, and then they have to plant where they have to make the stuff and then distribute it. Intuit and other software companies have 90% gross margins because their equivalent of chicken and broth is 0 and 1, and that's free. So my point was that Intuit starts out with 40 or 50 points of gross margin superiority, which they can then plow back into sales and marketing and research and development to make their products better and better known. And that leads me to the second part of your question, which is, aren't they more vulnerable because they're tech?
Yeah.
That's the historic rap on tech, that tech has no moats, that a semiconductor gets made, but then everyone else copies the semiconductor. Computers are commodities. You know what? TurboTax is not a commodity. That's Intuit's first major product. And QuickBooks Online is not a commodity.
Okay.
These are consumer products.
Yeah.
Exactly like Campbell Soup.
Yeah.
They have customer loyalty. They're constantly improving them. And by the way, I would argue that it's harder for a consumer to leave TurboTax or QuickBooks Online than it is for them to leave Campbell Soup. Because once you have your tax records in there, once you have running your small business on QuickBooks Online every day, tearing that out is really hard. It's not really hard to change from Campbell's chicken noodle to Progresso chicken noodle. So that's the insight, that these businesses used to be sort of boom and bust, and tech was sort of boom and bust. These are no longer speculative businesses. These are consumer products companies, every bit as much as Coke and Campbell Soup, but with superior business attributes.
Love that. Look, this year, and I guess the back end of last year, we've seen some big names. The FANGs, for example, crashed between 25-50%. I think Amazon, when I last checked, I think it was down 31% year to date, roughly, maybe a little bit higher, maybe a little less. Some would say, though, it makes a little bit of sense. We're not in that 0 rate environment anymore, and COVID was a once in a lifetime tailwind for them. Once we got past that sort of March low. If you take the two today, how do you think about valuation, especially with some headlines suggesting that 2021 was not relevant as a base year for valuation going forward? Like, how do you sort of see that?
Again, another good question. I tend to take a sort of a longer term view in the sense of, the digital age is really just beginning.
Yeah.
And there's no doubt that COVID accelerated the trend. And now we're seeing that trend sort of short-term kind of tail off. I mean, a lot of it's sort of technical in the sense that, in 2021, Amazon was growing 45%.
Yeah.
And now they're growing 0, roughly.
Mm-hmm.
So everyone says, oh, it's over. No, it's just that the pandemic pulled forward, essentially a year of demand. So if you average 45 and 0, they're growing 20-some%, which is just fine. And that was roughly their trajectory pre-pandemic. So to suggest that these companies, whether it's, any digital company that operates in online, whether it's computer or mobile, to suggest that their best days are behind them, you would have to just sort of argue that, e-commerce is really kind of over. That, that people are going to go back and shop in the high street or in the mall. Like, okay, if you want to, I'll bet you, I'll take that, the other side of that bet. It's just wrong. What we're seeing now is a post-pandemic sort of correction. And in terms of interest rates, no question that rates were, too low for too long, and now they're rising, and it's, in that sense, the stock market having a bad year this year is entirely rational.
Makes sense.
Because interest rates are the single biggest determinant of stock value. But on the other hand, business quality wins over time, full stop. So interest rates can do what they want, but Amazon, Alphabet, Intuit, and other tech companies that you and your listeners may identify are going to keep on growing for 5, 10, 15, 20 years. And you know what? In the long run, interest rates, schminterest rates. It's not gonna matter because they're going to be bigger and better and more profitable in the years to come.
For sure. I mean, you mentioned there, and I agree with it. I'm sure many people do that. The digital age is, it's still very early. And Adam, for our listeners that don't know, you're a big rugby fan. So let's use a bit of a rugby analogy. And rugby, game of 80 minutes. If we take the digital age, where is that in the rugby game? Is it in the warm up? Is it in the first half? Are we in the second half of that? Where do you sort of see that at the moment?
Good one. Sort of, if I had to ballpark it, sort of 15th minute, maybe.
Okay.
We're sort
game
of
started.
Getting close to the, the half of the first half.
I
mean, people, they don't pay attention or quantify these things. They say, Google and Amazon and stuff is so big that, how can they get bigger? Like, well, I'll tell you how. I mean, just look at the numbers. Like, Amazon's share of total retail commerce in North America is 5 or 6%. They just started selling as much stuff as Walmart. Like, it's not that big. Like, where's that number going to be in 10 years? Google has maybe 15, 20% of the worldwide advertising market. Here again, it's not that big, and then of course, Alphabet owns Android, which has not yet really been monetized, and YouTube, which has not really been monetized, and Google Cloud Platform, which is just getting going. So, so these companies, even though they're already huge,
there's still way to go.
Still have a lot of runway. Intuit says that, their QuickBooks Online product, hits 1% of their ultimate addressable market. Even if they're wrong by a factor of 10, it's only 10% of their addressable market. So, I mean, these companies have very long runways, but at the same time, they have protected businesses. Intuit, their leading competitor is a publicly traded company down in New Zealand called Xero. They have Xero has a third fewer customers than Intuit, QuickBooks, and Intuit spends 10 to 12 more times more on marketing and R&D than Xero. Like, who's going to win that battle? Like, it's kind of like, watching, capitalism like war. And you just say, well, here's one army that has 3 times more subscribers already against this guy, and they're spending 12 times more to improve the product and get it better known. Like,
no contest by the end.
It's no contest. It's like, the England rugby team playing, my old club in Princeton, New Jersey. You know?
Well, with England at the moment, it might be
Well,
close.
that's true. Good point. I might favor us. Yeah, that's true.
Yeah. Adam, what's your thoughts on index funds or like a smart portfolio made up of companies? Would that be based on Value 3.0? Are you a fan of index funds?
I think index funds are fine for people who really know their limits.
Hmm.
Like I can't figure out what a moat is, and I don't know. I just don't have confidence in my ability to tell whether Netflix or Meta has a moat. So I'm gonna pass.
Hmm.
So in that case, buying an S&P fund or a Nasdaq fund
Yeah.
or a tech index is great. Knowing your limits is really important as an investor. As I say in the book, I give some advice about this.
Yeah.
But on the other hand, smart portfolio is very good, like a thematic portfolio. Like let's pick 15 stocks that are tech companies that have moats that are reasonably priced. Yeah, I like that idea.
Yeah, and I guess you can diversify that way as well. So yeah, I like the
Yeah,
sound.
yeah, that's good.
Um, Adam, thoughts on crypto? Is that something you're interested in at the moment? I mean, you talk about your experience buying Bitcoin in the book, which at the time
Yeah.
was obviously very successful. Now we've sort of seen the correction. I think the high was back in November, and it's come off obviously since then. Has this changed your thinking about Bitcoin or crypto in any way?
Well, I've never been a huge fan of crypto, Sam.
Yeah,
I say in the book that I bought it sort of as a lark.
yeah,
Like an old boss of mine used to say, buy a little and see how it feels.
hmm,
And I think that's good advice because you don't really pay attention if you don't own something.
agreed. Yeah,
So I bought a de minimis amount of Bitcoin, and I say in the book it went up 6 times, and then my crypto hedge fund buddy told me to switch to Ethereum, so I did that, and it's worked out fine even with the correction.
good.
But I am not a big fan of crypto as an investment, Sam.
Hmm.
And I'll tell you why, because it's
Yep.
kind of novel. Usually, crypto, you know, boils down to, true believers, this is going to change the world. And, older guys like me saying, oh, yeah, crypto, yeah, made up. Well, I'm fine with crypto being made up because you know why? Gold is made up. Like,
Yeah,
why is gold valuable?
yeah,
Because
yeah,
it's
yeah, yeah,
tiny and rare. But over time, people agreed on it.
yeah,
Why is the dollar valuable? Because we agree it has value.
yeah.
There's no underlying value to it. So I'm fine stipulating that crypto can be a currency or a storehouse of value. But if I'm fine with that, then the crypto, maniacs have to concede to me that it's just a currency at the end of the day.
Mm.
It's just a storehouse of value. Its value is imputed to help the blockchain function, which I understand, and it's very valuable. But I prefer, Intuit and Amazon and Alphabet and, some of the other non-tech businesses that I write in the book, because
Yeah,
it's not all about tech. But in general, I prefer dynamic, growing businesses. Crypto is a currency. So I'm not going to invest in crypto for the same reason I don't invest in gold. The same reason I don't invest in the pound or the
yeah,
dollar or the euro. It's just inert.
yeah.
As Buffett famously once said about gold, if I buy it, it's just going to sit in a room and look at me.
Yeah,
It's not
yeah,
going to grow. It's not going to change. It's not going to make money. It's not
yeah.
going to make more money. It's not a business. It's just an inert thing. So I pass.
Yeah, no, and I love hearing different sides of it. And I guess let's go back to the rugby analogy. We say digital age, 15 minutes in. I guess crypto is such a new asset that maybe it's still in the warm up phase, really trying to find its feet for the long term. So I guess watch this space and we'll see.
Yeah.
Last question. The time has flown by. I found it really
Yeah.
interesting. If you could go back in time, um, and focusing here on the book, would you change anything? Would you add something different, or is it a case of, you know what, maybe I've got a new book coming in the future, and then you can change it that way?
No, I'm happy with how the book turned out. I put in the book, 20 times earnings or adjusted earnings once you make the accounting adjustments,
Mhm.
is the right hurdle rate for me. I still feel that's a good rate. I was aware when I wrote the book that rates were super low,
Yeah.
and I didn't know they were going to go up, but I knew that it was a good possibility. So I set my hurdle rate at an acceptable level. So I'm fine with that. The fact that the tech market corrected soon after the book, or as the book was being published, doesn't change my sort of generational view that, these businesses are here to stay. They are consumer product companies. They have multiple moats. They're better mousetraps than any business ever built before. And, they're where the money is. So, no, I feel generally good about the conclusions in the book.
Fantastic. Yeah. And that we'll probably put a link in the bio, but yeah, the book Where the Money Is, of course, is out and available for people to read. And I hugely recommend people do that. Adam, it's been an absolute pleasure having you on. I've found it very interesting, and I'm sure our audience will as well. Thank you very much.
Well, thanks for the good questions, Sam. And if people want to hit me up on LinkedIn, I'm happy to answer any questions they might have.
Awesome. That's great for them. Thank you very much.
Good. Cheers.